Despite a challenging operating environment, our banking system remains resilient with healthy levels of capital and liquidity buffers. Total capital ratio stood at 18.8% at the end of last year, and this is notably higher compared to the levels observed during the GFC. The LCR and NSFR also remain steady at 154% and 118% respectively. And we also tested the resilience of our banks and insurance companies through our annual stress test exercise, where our banks and ITOs are subjected to the operating environment scenarios that are much more severe than that observed during the GFC and the 2020 pandemic. And the stress test results reaffirm that our banks are sound, with total capital ratio remaining well above the minimum requirement of 8% under adverse scenario. It is also worth noting that the impact of the recent US and Swiss banking sector stress in our banks have been minimal. Banks in Malaysia have limited exposure to the troubled US and Swiss banks. The depositor base of our banks is also more diversified. In terms of the impact of mark-to-market losses to rising interest rates on the bond holdings of banks in Malaysia, this remains well within the internal capital targets of banks. Banks also continue to hold high levels of high-quality liquid assets in the form of placements with Negara Malaysia and government bonds that can also be pledged with the bank to meet any additional liquidity needs.
Do you think there will be similar incidents in Malaysia, like Credit Suisse, over the next 12 to 8 months? And allow me to also ask, because last year bond yield was relatively higher, we were made to understand that some of the banks in Malaysia have requested the central bank's permission to allow them not to mark-to-market of this paper loss. We are wondering whether that's true. Thank you.
Okay, thanks, Chester. I think Gavin, maybe do you want?
Let me just answer that. Bulan puasa, my memory. So what I say, that's why we take pains to stress test our banks. So the starting point is already very high. So you have a situation where the capital ratio is at 18.8%. And the stress test that we subject our banks to, the details are in our EMR, are talking about, an economic environment is much worse than the pandemic. So you're talking about, a GDP contraction of much worse than what we saw in 2020. And we're talking about bond yields at levels much higher than what we have seen in the past, and even exchange rate against the US dollar at levels that we have not seen in the past. So when you took all that together, the bank's capital ratio is still above the minimum requirement. So no, our banks are still resilient, and we do not expect what we see in the other countries to happen here in Malaysia. And secondly, all our banks are subjected to very stringent capital and liquidity rules. Regardless of whether you are big, you are small, you are local, you are domestic, you are subjected to the same rules, unlike in the US where such rules are only applicable to the large banks. So when it comes to the mark-to-market losses, bonds that are whole in the banking book, which are not mark-to-market, is very small. It only accounts for about 6%, 7% of the total assets, unlike Silicon Valley Bank, which is about 40%. So even if you were to mark-to-market the 7%, the capital ratios of the banks would just decline by another 1 percentage point. And the capital rules currently requires bank to mark-to-market the bonds that they hold in the AFS, and such losses are deducted from capital. So that is our rule currently. So the 18.8% that you see are net of mark-to-market. It's already revalued at fair market values. And it is not true that some banks have written to us to get dispensation from complying with the accounting standards. And if they do, their accounts would be qualified in that case. And you will be able to detect that from the annual accounts.